If you've been watching Pi's price, you already know it's been a difficult stretch since the Open Mainnet launch. Pi is currently trading around 0.8 cents, far below where many pioneers hoped it would be by now. Today we do an honest fact-check technical breakdown. No hype, no price predictions, no wishful thinking. Just what the charts and data actually show, what's driving the pressure, and what would need to happen for sentiment to shift. Where we are. Price context. Pi's Open Mainnet launched on February 20th, 2025, marking the point where external connectivity was enabled and transfers to supported centralized exchanges became possible. That was a genuine milestone, but the price action since has told a different story. Pi has been in a broader downtrend for an extended period, with occasional short-term recoveries that haven't held. As of July 2026, it's trading near 0.08 cents, a level that sits close to an important support zone. For context, Pi's all-time high was $2.99. At 0.8 cents, the token is roughly 97% below that peak. That's the reality of where we are before discussing any indicators or potential scenarios. Technical indicators? Let's look at what the charts are actually showing. The Relative Strength Index, RSI, has been in oversold territory. RSI measures the speed and magnitude of recent price movements. When it drops into oversold territory, it signals that selling pressure has been unusually strong and may be becoming exhausted. This can increase the probability of a short-term relief rally. But oversold is not the same as bottomed. An oversold RSI tells you selling has been extreme. It doesn't tell you when buyers will step in or whether they will at sufficient volume to reverse the trend. The MACD moving average convergence divergence has remained bearish for much of the recent trend. The MACD reflects momentum, and a bearish reading means downward momentum is still in place. Until the MACD crosses bullish, the path of least resistance remains downward. Together, these indicators paint a picture of a market that's been heavily sold, showing early signs of exhaustion, but without confirmed reversal signals yet. Key levels, support and resistance. Two price levels matter most right now. The 0.75 region has been acting as an important support level, a floor that buyers have defended multiple times. This is the level to watch on the downside. If Pi breaks and closes below 0.75 region with meaningful volume, it would signal potential for further downside and remove a key technical foundation. On the upside, $0.10 is the first significant resistance level bulls need to reclaim. It's both a psychological level, a round number that traders pay attention to, and a technical level where previous buying has failed to sustain. A clean break and hold above 10 cents would be the first signal that sentiment is beginning to shift. Until that happens, any rallies are likely to face selling pressure around that zone. Why is Pi under pressure? The honest answer is that multiple factors are contributing, and it's important not to oversimplify. The most discussed factor is the ongoing release of Pi into circulation. As KYC approvals continue, and more pioneers complete mainnet migration, additional Pi enters the market. Some of those newly migrated holders choose to sell. When supply consistently increases and demand doesn't match that pace, price declines. That's basic market mechanics. But migration is one factor, not the only one. Overall cryptocurrency market sentiment matters. Liquidity conditions on the exchanges where Pi trades matter. Speculative positioning in derivatives markets matters. One nuance worth understanding. Open interest data, which tracks the total value of active derivatives contracts, reflects speculative activity on exchanges, not Pi's broader ecosystem. Most Pi holders still keep their coins in mainnet wallets, rather than actively trading futures. So, rising open interest signals more speculation, but it shouldn't be read as a measure of Pi adoption or network health. What would need to change? A sustained recovery in Pi's price would likely require several things happening together, not just one. First, stronger buying demand that consistently absorbs the ongoing supply from migrations. Second, continued ecosystem growth, more apps, more utility, more real-world reasons to hold and spend Pi rather than immediately sell it. Third, improving overall crypto market conditions, since Pi doesn't trade in isolation from the broader market. The ecosystem development is real and ongoing. Pi continues expanding Pi-powered applications, developer tools, smart contract infrastructure, and real-world utility initiatives. Pi 2-Day 2026 delivered Solo Host, Pi Sign-In, and Pi Verify, all designed to extend Pi's utility beyond its own ecosystem. But ecosystem development and price recovery operate on different timelines. The question is whether utility growth can outpace supply pressure fast enough to shift market sentiment. Balanced take. Let's be direct about what this analysis can and can't tell you. Technical indicators are tools for reading current market conditions. They don't predict the future. An oversold RSI and a key support level are useful reference points, not guarantees. Anyone presenting this as a certain bounce or a certain further collapse is overstating what the data shows. What the data does show is that Pi is in a long-term bearish trend, attempting to stabilize near an important support zone, with indicators suggesting selling may be becoming exhausted, but without confirmed reversal signals yet. That's the honest picture. Manage your decisions accordingly. Pi at $0.8, RSI oversold, MACD bearish, support at $0.075, resistance at $0.10. Ecosystem building continues, but supply pressure remains. That's the technical reality in July 2026, presented as clearly as possible without the hype. What's your current position on Pi, holding, accumulating, or waiting on the sidelines? Drop your thoughts below. And subscribe. We'll keep tracking Pi's price and ecosystem developments as they develop.